Good afternoon, everyone. Thank you for joining us for today's program, COVID-19 Response Legislation, Economic Relief for Small Businesses. I am pleased to hand it off to John for an introduction to today's program. John S. Meyer Jr. is a shareholder at the firm and chairs the business and real estate practice groups at Cape Sokol. Now on to John.
In the last couple of weeks, we've seen news from clients and friends of Paycheck Protection loan approvals and even funding. But as you've probably read, all $349 billion that Congress committed to this program is spoken for. And Congress is now on the cusp of approving another $310 billion. The Paycheck Protection Program is designed to encourage retention of employees. However, questions about loan forgiveness are rampant, and I hope we'll get into some of the answers today. This is true especially for businesses that do not anticipate rehiring furloughed workers anytime soon. In addition to more money, there is hope of some relaxation of the current 8-week spending period, during which the proceeds of a paycheck protection loan have to be utilized to maximize forgiveness. The Federal Reserve has stepped into the fray in a major way, committing $500 billion to buy paycheck protection loans and corporate bonds. This will inject needed liquidity into the economy. Not since World War II have so many people across the globe been joined in a fight against a common enemy. Unlike the Axis powers, our enemy today is unseen, and the economic damage of COVID-19 is self-inflicted, as we've chosen to shutter all but essential businesses to limit the virus's spread. These are dark days, yet history suggests there's cause for hope. After World War II, the world emerged stronger and better in important ways. Economies thrived. National leaders had newfound appreciation for alliances and communication among nations. NATO and the United Nations were formed. Likewise, the corona pandemic forces us to acknowledge the interconnections of humankind. When ignored, our linkages can allow deadly viruses to spread like wildfire. But by working together, we'll get through this pandemic with limited loss of life and damage to the world economies. In the US, our politicians have already begun to work together. In Washington, D.C., party lines were crossed to pass the $2.2 trillion CARES Act, signed into law on March 27th. CARES supports healthcare financially, it promotes telemedicine, and it authorizes the president to mobilize industry to produce medical supplies and equipment. CARES provides enhanced benefits to furloughed workers. CARES offers $500 billion in loans to medium and large businesses. And as we'll discuss today, CARES offers $349 billion in forgivable loans to small businesses and nonprofits. Alternatively, CARES offers deferred payment of payroll taxes and tax credits for businesses that retain their workforce. $2.2 trillion is a lot of money. In the 1940s, the US spent $4.1 trillion in current dollars to defeat the Axis powers. To help pay that tab, the top marginal tax rate was raised to 94%. Yet the stock market surged over 130% in the 4 years after Japan attacked Pearl Harbor. During that time, the federal government harnessed industry and science to defeat our enemy. The gear up for war stimulated the economy. Republicans and Democrats joined hands to convert manufacturing plants from making cars to tanks and aircraft. A massive shipyard was built in virtually no time in San Francisco Bay to bring our fleet up to the level it would need to be to defeat the Axis. Anyone who's interested in reading a truly uplifting story about how this country mobilized and joined forces without regard to political parties, I commend you to Arthur Herman's freedoms forge. Our economy is currently taking a massive hit, and it's our duty as professionals to help our clients, and by working together to help our clients and businesses put the tools of the CARES Act to work, and to search for other creative ways to advance commerce and produce essential goods and services and get our economy geared up again when it's safe. Toward that end, my colleagues and I are honored to share with you what we have learned as we've devoted many non-billable hours to reading and analyzing CARES and the evolving rules and regulations. I hope you'll find useful the guidance in our written materials. I'd also suggest you feel free to click on the Insights tab on the Cape Sokol website, where you'll find a continually evolving set of information. In the days ahead, I encourage everyone to share questions, challenges, and solutions. If we meet the COVID challenge united, we'll emerge sooner and stronger than before. Now I'll briefly introduce our presenters. And as Alex said, more detailed biographical information is in your packets. Laura Al-Shatir is a shareholder and attorney at Cape Sokol, where her practice focuses on tax controversy and tax planning. She'll speak about the Payroll, Tax Deferral, and Tax Credits program under CARES. Then Michelle Schwerin will talk about the Paycheck Protection Loan Program. Michelle is a JD CPA and shareholder at Cape Sokol, where her practice focuses on tax controversy and business and real estate matters with emphasis on supply chain contracting. Danny Durbin is a lawyer and associate with Cape Sokol, where she practices in the business and real estate and intellectual property areas. Danny will speak about the CARES Act and how it modified the disaster loan program. Laura, take it away, please.
Thank you, John. So as John mentioned, Michelle and Danny are going to get into a discussion of, really the crown jewel of the CARES Act, but I'm going to, which is the Paycheck Protection Loan and the EIDL loans as well. But I'm going to start by talking about the Employee Retention Payroll Tax Credit. This is an opportunity for employers to take advantage of CARES if they would not have been able to take advantage of the PPP program. Because importantly, if an employer receives a PPP loan, they are not eligible for the Employee Retention Tax Credit, which I'll refer to as the ERTC. Now, by and large, if an employer is eligible for a PPP loan that is ultimately forgiven, that employer would be better off using the PPP than the ERTC. But given that the PPP funds are currently not available, and we're not certain, but hopeful that there will be more funding available, this could be a provision that employers will want to take advantage of. Furthermore, if not all employers are eligible for the PPP program, so the ERTC is something to keep in mind. For instance, if an employer has greater than 500 employees, or won't qualify for loan forgiveness for any of the variety of reasons that Michelle will get into more in depth later on. But basically, the ERTC is a credit against the employer portion of FICA tax, which results in either less money being sent to Treasury or an amount being paid by the federal government to the employer. The amount of the credit is based on qualified wages paid each calendar quarter between March 13, 2020 and December 31, 2020. There's no overall dollar limitation for the ERTC, but there is a per employee cap, which is generally $5,000, although we'll get into some specifics to delve into that further. So to calculate it, we're going to walk through each of these sort of 5 steps. First, we'll talk about employer eligibility. We'll talk about which calendar quarter, for which calendar quarter an employer is eligible, because eligibility is examined on a per quarter basis. We need to talk about and determine what wages are considered qualified wages eligible for the credit. and then we'll walk through calculating and claiming the credit. So employer eligibility. As I mentioned at the outset, if an employer receives a PPP loan, they are not eligible for the ERTC. The employer must have carried on a business in 2020. But tax-exempt employers are also considered to be eligible. And the employer must satisfy one of the following tests. Their business must have been either fully or partially suspended in a particular calendar quarter in 2020 by a government order due to COVID, or the employer must experience a significant decrease in gross receipts during the calendar quarter 2020 compared with that same quarter in 2019. Now, there's guidance on the IRS website, which has been really very helpful. There's a whole section of the IRS.gov website that's devoted to COVID-19 guidance. And there are FAQs that address what it means for a business to be fully or partially suspended. And I'm going to give you one of the examples. So the example is, if there was an order mandating that a restaurant cannot serve patrons in person, but can still continue to do carry out and delivery service, that would constitute a partially suspended business. And so that restaurant would be eligible for the credit. There's also guidance regarding what are considered to be gross receipts or a significant decline in gross receipts. Gross receipts is basically just defined by reference to Internal Revenue Code section 448. And the regs under 448 define gross receipts as gross receipts properly recognized under the taxpayer's accounting method for federal income tax purposes. So generally, it's all total sales, net of returns and allowances, and all amounts received for services. So I mentioned again, we look at this quarter by quarter. So an employer has to satisfy those eligibility requirements in any particular quarter for which they would like to claim the credit. Now, determining qualified wages. This is done on an employee by employee basis. And there are different standards depending on the number of employees employed during 2019. So if an eligible employer averaged 100 or fewer full-time employees in 2019, the qualified wages would essentially be all wages paid to a particular employee in that particular quarter. Wages are basically all wages subject to FICA, but they do not include wages that are paid under the Families First Coronavirus Response Act. You may recall that was one of the first rounds of legislation that required businesses to provide paid leave and sick leave and family leave for employees impacted by COVID-19. So those wages are not considered wages eligible for the credit, the ERTC. But otherwise, it's basically all wages as well as qualified health plan expenses. If an employer averaged over 100 full-time employees in 2019, then qualified wages are only wages paid to an employee who is not providing services. So if you're one of these larger employers, you've got to be paying employees even though they're really not working. And in any case, qualified wages are paid are only those that are up to $10,000 total. So let's see where like the rubber meets the road and how we calculate the credit. It's generally 50% of those qualified wages up to $10,000 paid by the employer per employee for the relevant quarter. And again, those FAQs on the IRS website are very helpful, and I'm going to give you two examples. The first is as follows. Eligible employer pays $10,000 in qualified wages to employee A in quarter 2, 2020. So the ERTC for that employee would be $5,000. Now suppose that the eligible employer pays A only $8,000 in qualified wages in quarter 2, but also pays $8,000 in quarter 3. Well, the ERTC for that employee would be $4,000 in Q2, but only $1,000 in Q3 because again they're limited to it's basically $5,000 total, or qualified 50% of qualified wages up to $10,000. So that employer would take advantage of the credit in both Q1 and Q2 for that employee. So then, how do dollars come in the door? Well, the credits are taken against the employer's share of employment taxes that are reported on the quarterly employment tax return, so generally Form 941. So the employer can reduce its share of employment tax deposits by the amount of the anticipated ERTC. But if there are insufficient deposits to claim the full amount of the credit, the employer can also get an advance from the government by filing Form 7200. And also, if the credit ultimately exceeds the employer's portion of employment tax and the employer has not requested that advance, well, then the employer will get a refund, basically, in order to put the full amount of the credit into the hands of the employer. One other thing that's I think important to mention is that we believe that if an employer determines after having filed Form 941 that they actually could have taken advantage of the ERTC, well, we believe you can still file an amended 941, a 941X to claim that credit retroactively, as long as it's timely filed. And another thing that is important to note is that the ERTC does not affect the employer's obligation to collect and remit federal income tax, or state withholding tax, or the employee portion or the trust fund portion of employment taxes. So again, the ERTC only offsets the employer portion of employment taxes. So I'm going to just talk briefly about the next payroll tax provision in the CARES Act, and that is employer payroll tax deferral. So this option is not available if the employer had indebtedness that was forgiven under a PPP loan. If the employer is eligible, basically they get to defer the employer's share of the Social Security portion of FICA that would have been required to be made between 3/27/20 and 12/31/20. The employer could defer half of that amount until the end of 2021, and then the other half until the end of 2022. Some guidance in the way of FAQs came out recently, which address a situation where an employer is deferring payroll taxes before they know, or before a PPP loan is ultimately forgiven. What happens to those payroll taxes that were deferred? Well, the guidance says that deferral is still effective. So payroll taxes that were deferred prior to the PPP loan forgiveness can continue to be deferred until the relevant date. But as soon as the PPP loan is forgiven, then the employer may no longer continue to defer payroll taxes under this provision. So that's kind of it in a nutshell, and I'm going to turn it over now to my colleague Michelle, who will introduce the next segment.
Great, thanks, Laura. And before we start, Alex, will you put up a poll question for us, please? Okay, so this poll question asks, are you or your clients interested in taking advantage of employee retention tax credit, employee payroll tax deferral, PPP loan, or none of the above? Please select one, and there's no right answer. If you answer any of these, it will count toward your credit.
Okay, about 20 more seconds. Ten more seconds. It looks like we have 92% people voting. Just make sure to vote if you're asking for a CPE. Okay, I'm going to go ahead and close the poll.
Thanks, Alex. So with respect to SBA loan programs, there's been a lot of talk recently about these new programs following the CARES Act. And we wanted to give you a bit of an overview of the SBA loan programs in general, because we think it'll help give some context to these new programs. So both loan programs under 7A and loan programs under 7B2 existed before the CARES Act was enacted. Loans under SBA Section 7A historically have been in place to provide general program loan funds to assist small businesses. For example, purchasing equipment, purchasing property, purchasing the business itself, and is a program that is guaranteed by the SBA, and it's designed to encourage lenders to extend credit to small businesses throughout the country. Section 7B2 loans under the SBA program are economic injury disaster loans. And historically, these are loans that have been applied and come into place normally in the case of physical disaster. So a prime example would be after Hurricane Katrina, the SBA came in and extended economic injury disaster loans to small businesses in the New Orleans and Louisiana areas. The CARES Act doesn't actually make new loan offerings or new loan programs under the SBA programs. It just provides temporary changes to each of these programs in order to respond to the economic reality and economic difficulties that COVID-19 and the pandemic that we're facing right now have generated with respect to small businesses. And so I'm going to ask Danny to speak on the 7B2 economic injury disaster loans first, because some of the provisions in that section come into play with respect to the 7A PPP program, which is the temporary change to the Section 7A loan program.
Thank you, Michelle. Okay, so like Michelle stated, I am going to be speaking about the economic injury disaster loans. And first, I'm going to start off with the eligibility requirements. So as long as the business that wants to borrow these funds has been in operation as of January 31st of this year, it also has to make sure one of the following applies in order to ensure that that business is going to be eligible for this economic injury disaster loan. And you'll often hear it referred to as an EIDL loan. So because this is a high-level overview, we're focusing on the eligibility requirements that are the most applicable. And those would be that the business that is applying for the loan has no more than 500 employees. So if that business was in business as of January 31st of this year and has no more than 500 employees, it is eligible for an EIDL loan. However, if it has more than 500 employees, that doesn't automatically mean that it is ineligible. There is what is known as a size chart. And what that size chart does is it sets a maximum size for a small business concern. And it's measured by the number of employees or the average number of annual receipts as compared to its industry. So we see a lot in the manufacturing industry that a business can still be deemed a small business concern with more than 500 employees, so long as in looking at that chart, it doesn't exceed the chart's maximum. So that is another way for a business to be eligible. Another is if the business was in operation as of January 31st and is deemed a private nonprofit organization. And that's essentially a state registered nonprofit. And for that, it can be of any size. So it does not have the employee count limitation. The one thing to keep in mind when you are determining your business's size in terms of number of employees or in terms of the average annual receipts, if you're looking at that small business concern chart, is that it can be affected by the number of the business's affiliates. And when you are determining your total number of employees or the total number of annual receipts, it's not just about including the business that is applying for that EIDL loan, their number of employees or annual receipts. You're going to factor in affiliates. And a business is deemed to have an affiliate when one controls or has the power to control the other, or a third party does. So it does not matter whether or not the control is exercised, so long as the power to control exists. So if a member of the business that wants to borrow an EIDL loan is able to control that business and then also is able to control another business, even if those two businesses aren't in the same industry, they are going to be deemed affiliates, and you are going to have to total up the number of employees for all affiliates and that business. Or if you're looking at the annual receipts under that small business concern chart, you're going to total all of that in order to make sure that you don't exceed the maximum. Another thing to note is that in calculating the number of employees, the term employee is going to include individuals employed on a full-time, part-time, or other basis. Okay, so moving on to the terms of the loan. Originally, under the CARES Act, it was up to $2 million. However, recent guidance has capped the maximum that you are able to receive under an EIDL loan at $15,000. The one saving grace, I suppose, is that this does not include that $10,000 grant. So whenever you go to apply for your EIDL loan, which you actually are not able to do right now, but when you did, there was a box that you could check requesting up to a $10,000 grant. So the loan is going to be a maximum of $15,000, but again, that does not include that up to $10,000 grant. With regard to that up to $10,000 grant, that is going to be determined based on a $1,000 per employee allotment. So that is how they calculate the grant amount. With regards to the loan, it's going to be a maturity date of up to 30 years. And if it's a for-profit borrower, they are going to be looking at a 3.75% interest rate, and a nonprofit borrower is going to be looking at a 2.75 interest rate. No matter what, though, they will be able to defer principal, interest, and fees for up to a year. And the one nice thing about the EIDL is that if it's not rolled into the Paycheck Protection Program that Michelle is going to speak about, it's not forgivable. But if it is, then it is going to be forgivable, aside from that up to $10,000 grant. The actual loan amount is going to be based on the business's actual economic injury and financial needs. So in essence, the loan is meant to provide working capital that is necessary to resume normal operations, and then also for expenditures that are necessary to alleviate the economic injury. It's not meant to exceed that which the business could have provided had the injury not occurred. Once a borrower does receive the loan, it can be used to pay for fixed debts, payroll, accounts payable, and any other obligations that cannot be paid as a result of the coronavirus. However, the loan proceeds cannot be used to refinance a debt, to make payments on loans that are owed by other federal agencies, to pay tax penalty obligations, to pay dividends to stockholders, or to repair physical damages. And recall when Michelle was giving an overview of these EIDL loans that there are different types of disaster loans. And we typically have seen those with relation to like the Hurricane Katrinas. And a lot of people will get a physical disaster loan. This is an economic injury disaster loan, so it makes sense that the proceeds cannot be used for physical damage. Now, real quick, we are going to go to another poll. Alex, if you don't mind putting that up. Okay, so did you successfully obtain, you or any of your clients successfully obtain an economic injury disaster loan and or the emergency grant of up to $10,000? You can select yes or no. And what's interesting is these have actually been slower to roll out than the Paycheck Protection Program. The emergency grant was obviously meant to be showing up in borrowers' bank accounts within 3 days, and that did not happen.
Okay, about 15 more seconds. Okay, I'm going to go ahead and close the poll. It looks like we have 33% yes and 67% no. Back to you.
Interesting. Okay, thank you so much, Alex. Okay, so one of the reasons I was interested in learning about that is, like I said, what we have been hearing is that this has been slow to roll out, and that people have essentially had more success through the PPP program. Because funds have essentially dried up, we do know that that as far as the temporary status goes, or sorry, the current status goes, that Congress is attempting to pass another bill regarding additional funding. So when that does happen, hopefully you will be ready to go through with this guidance. And on the SBA website, there actually is the link that you would apply through. Again, you cannot do so at this moment, but once that opens up, pending additional funding, you just have to use an online portal on the SBA website, and this loan is going to be administered through the SBA as opposed to a third-party lender. The other item to note regarding this loan is that a personal guarantee is going to be required if the loan is in excess of $200,000. To the extent the EIDL loan is less than that, then there is going to be no personal guarantee. And again, pending additional funding, this program is anticipated to be open to be able to apply through December 31st. And the current status right now is that there's going to be an extra $60 billion of funding for this program. So it looks like the slides are a little out of order. I'm going to turn it over to Michelle. And Alex, I don't know if we can move it back. Perfect. Thank you.
Fantastic. Thanks, Danny. So I'm going to spend a little bit of time talking about the Payroll Protection Program loans. And you might ask, why are we talking about these now? As of last Thursday, funding ran out. But there are a couple of very important reasons why we are still talking about them. First is that many small businesses have successfully applied for and have been accepted into the program, and some have received funding. And there's still very many regulations and requirements that they must meet in order to take advantage completely of the program. So we're going to spend some time talking about that. And the second is that there has been talk in Congress about adding more funds to this program to allow more small businesses to take advantage of the program. And as of now, they have approximated over 800,000 applications that are still in the queue waiting to be processed. So I think that it is a program that is highly expected to continue and have more small businesses go into the program. So I'm going to briefly talk about the entire program overall, focusing on what is likely to come. As I do this, I want to add the important caveat that there is a lot going on with the payroll protection loans. The act was written very quickly. There are a lot of ambiguities in the act. The SBA issued what they call interim final regulations, which I find to be a very interesting characterization of what regulations are. But they have issued interim final regulations and also FAQs that are somewhat, and in certain places, internally contradictory. So there's a lot of questions that still remain. The SBA has actually affirmatively said they're coming out with more regulations on the forgivability aspect of these loans, but we still are waiting to see that information and hope that that will provide more clarity. Before I move on to the details of this loan, I want to ask Alex if she could add one more poll question. I think we missed number 1, so if she could throw that one up there. Okay, what are the biggest challenges and questions you or your clients face in getting the biggest bang from PPP loan bucks? Wow, that's a tongue twister. We'll keep that up for about a minute to allow people time to answer. And Alex, if you wouldn't mind reading the answers or showing the answers after this polling question, I think it could help guide our further conversation.
Okay, so we're going to go for another 20 seconds or so. And I'm going to go ahead and close.
Thanks, Alex.
Okay, so just to give you the answers, 48% said keeping employees employed, 11% said not reducing employee salary, and 60% said spending funds for qualified purposes.
Very interesting. And we'll talk about all of those over the next several minutes. So the Paycheck Protection Program Loans is the result of a temporary change to the 7A loan program. And it provides loans of up to $10 million to small business concerns. Small business concerns are businesses and certain nonprofits that employ not more than the greater of 500 employees or the business's applicable size standard number of employees. So that applies to certain industries, and the SBA has issued a chart in its regulations for certain industries that say, if you are in this industry, we consider you a small business if you have 800 employees or 950 employees. So if you are if you consider yourself a business that might be a small business concern or have a client who might be a small business concern and has slightly more than 500 employees, we'd encourage you to look at the size standard chart and look specifically at the number of employees in your industry to see whether you could apply. In addition, the business must be in operation as of February 15th, 2020. So this can't apply to businesses who start up during this time. And the business must have affiliates that it was paying salaries and payroll taxes to. When counting employees, it is important to remember the affiliate rules that Danny talked about earlier. The amount of the loan is calculated as the lesser of $10 million or the company's average monthly payments for payroll costs times 2.5. And when we talk about what constitutes a payroll cost, it's a very specific list of expenses, including salary, vacation, parental, family, medical, or sick leave, group health care benefits, such as insurance premiums for employees, retirement benefits, state and local employment taxes. What is explicitly excluded from payroll costs are the salary amounts that apply to employees that make more than $100,000. So the first $100,000 is incorporated in this payroll cost, but anything above and beyond is excluded for purposes of the calculation. And this loan amount also includes the amount of 7B economic injury disaster loan balances that Danny was talking about earlier, less the emergency grant amount, which is up to $10,000. And it's a very formulaic determination. So unlike the economic injury disaster loan that considers more of the business's situation and what the business has faced, this is very numeric and requires calculations based on prior expenses. I am having trouble moving the slides forward. Okay, so once received a loan, the loan proceeds can be used for several different kinds of expenses. It may be used for payroll. It may be used for the interest of mortgage payments. It may be used for rent. It may be used for utilities. It may be used for paying pre-existing debt obligations. Now, it's important to remember that the allowable uses of these loan proceeds is a greater category than the forgivability. So while a business might be allowed to use loan proceeds to pay, for example, pre-existing debt obligations, the use of those loan proceeds would not count toward the forgivability of that loan, as we'll discuss in a few minutes. Anything that's not forgiven has a 2-year, 1% interest rate term, and repayment is deferred for the first 6 months that the loan is outstanding, and it's 6 months from the date that the loan proceeds are dispersed. Okay, this slide talks about payroll costs. I briefly discussed this earlier, and I'm providing a list right here. The reason why I'm adding it here is that payroll costs are very important for the determination of whether a loan is forgivable. And so the majority of the expenses that a small business should use with respect to the proceeds of the loan should be dedicated to payroll costs, which include the salaries, wages, commissions, employee benefits, allowance for separation, group health care insurance premiums, retirement, and state and local employment taxes. So one of the most attractive aspects of the PPP loan is that a majority or all of it, depending on how the funds are spent, are forgivable entirely. And forgivability is measured by the amount that the small business spends in the 8 weeks following the loan closing on the payroll costs that we just discussed above, rent and or interest on mortgage payments, and utilities. And the forgivability is up to the amount of loan forgiveness. So if a small business uses the entire amount of the loan in the first 8 weeks on those expenses, then the entire loan amount will be forgiven. There are a few important limitations on the forgivability. And the first most significant one, I think, is that payroll costs must be at least 75% of the total expenses. So otherwise stated, the rents, interest on mortgage payments, and utilities are limited to 25% of the total amount of loan forgiveness. And this is because the intent of the PPP loan is to keep small business employees employed and compensated and hopefully working to the extent that they can. And so payroll costs should be the most significant amount in that forgivability analysis. Another important and very attractive element of this is that forgivability, normally when a loan is forgivable, it will be considered a cancellation of debt and included in the small business's income for purposes of calculating income tax. However, a PPP loan that is forgiven does not generate taxable income to the small business. So in that sense, it's more of a grant that is not subject to tax. There are two other very important caveats with respect to forgivability, and that's something that we're going to spend a little bit of time talking about, and that is how forgivability is reduced when a small business makes changes with respect to its employees. And the first way that a business makes changes and that will affect the forgivability is when a small business changes the number of full-time equivalent employees by furloughing or laying off employees. And in certain circumstances, when a small business does that, it reduces the amount of loan that's forgivable. And the way that the SBA is going to measure a reduction in the average number of full-time equivalent employees is by considering the average FTE, full-time equivalent employees, in the 8-week period following the disbursement of the loan, and comparing that number to either the average full-time employees of the small business between February 15th, 2019 and June 30th, 2019, so about the same time period 1 year ago, or the average full-time employees between January 1st, 2020 and February 29th, 2020. So comparing it to the first 2 months of the year. And the small business is allowed to use whichever comparison is most beneficial to them. If there is a reduction, then the reduction in forgivability is measured on a proportionality basis. So the proportion of the reduction in full-time employees is the same proportion that the total loan amount will not be forgiven. The other way that the loan forgivability can be reduced is by a reduction of salary for certain employees. This only counts for employees who make less than $100,000 in salary. But if a small business, the borrower, reduces one of those employees' salary in excess of 25%, when compared to the most recent full quarter that the employee was employed prior to the 8-week period by more than 25%, the amount of loan forgivability is reduced on a dollar-for-dollar basis. So the full-time equivalent employee calculation reduces the loan amount on a proportional basis, and the reduction in salary reduces the loan amount on a dollar-for-dollar basis. There is one great cure period. It's an ability for the small business to fix either of these reductions, and that is if the business eliminates the reduction of the full-time employees or eliminates the reduction in salary of wages of employees. So that means hiring back or hiring employees to boost up that proportion, or increasing the salary of the employees it has by June 30th, 2020, then the forgivability won't be affected. In order to achieve forgivability, the borrower must substantiate these expenses with payroll reports, 941s filed, rent invoices, mortgage invoices, utility invoices, and canceled checks. So we discussed that the current status of the PPP program is that funding lapsed. A significant number of loans have gone through, and Congress is now working on a new bill that's going to allocate a significant amount of money to the PPP loans. I also said earlier that there were a significant number of applications, over 800,000, that are outstanding specifically for the PPP program, with some lenders accepting applications to be put into the queue. So if you or a client has not applied yet but thinks that you would be, or the client would be eligible for the loan and could benefit from the loan, we would highly recommend you looking into the application process and at least taking the first couple of steps to get your application ready if a new round of funding is provided. Let's see. So the SBA is also providing relief with respect to other programs, and we thought it was important to mention these to the extent that you or your clients have other SBA loans outstanding. And that is that if you have a client, or if you have a disaster loan that was put in place before March 1st, interest will continue to accrue, but there's a deferral on all payments through the end of the year. If there is a current 7A, which would be a small business loan for general operations or purchasing of the business, a 504, which is a loan for certain minority small businesses, or microloans, the SBA will automatically pay the principal, interest, and the fees for those loans, which is very helpful to many of those businesses. I also wanted to mention a couple of non-SBA related funding opportunities that, while I was preparing for this presentation, I came across, and think that if you are advising a client with respect to what to do now, that there's uncertainty with respect to continued funding, or if you have a client who's stuck in that queue of over 800,000 applications still in place, the U.S. Chamber of Commerce has a Save Small Business Fund, which might, I know it's limited to certain situations, but might be applicable to your clients. And then there are a number of large companies who are providing funding on a smaller scale, but it could be helpful. Facebook has a grant program. Salesforce just announced a grant program for small businesses. And I know Google Ads is providing some sort of credit program for small businesses. And I know that's just a few of many opportunities for clients. So I'm going to pause really quickly for another polling question. How are you advising as to the PPP loan program? please select one. We'll keep it open for about 45 seconds to allow you time to vote. These polls, by the way, are completely anonymous as to your answer. We aren't really, I mean, we're not looking at them with respect to how you are answering. We're looking at them to see if you answer in order to be able to verify your attendance.
Okay, about 15 more seconds. Okay, I'm going to go ahead and close it down. Okay, it looks like we have 20% who are actively marketing and 77% who are just responding to clients' questions.
Wonderful. Thank you. So I'm going to open it up in our last 2 minutes to questions, although I will also highly encourage everybody to reach out to any of the 4 of us with outstanding questions, concerns, thoughts. We've spent a lot of time really getting into the weeds here, and even though there are still so many outstanding questions, this is something that we have all become immersed in and enjoy talking about, and are trying to use to help small businesses in the St. Louis area and the region.
And Michelle, it looks like we do have some questions through the GoToWebinar control panel. Some of them are related to the EIDL loan. And I'll address those 2 real quick. So one question is, what is the maximum amount a business can borrow under an economic injury disaster loan? And again, statutorily, that was up to $2 million, so under the CARES Act. But recent guidance came out last week that the maximum was going to be $15,000, in addition to up to a $10,000 grant. So assuming you get up to $15,000 and you get the up to $10,000 grant, that'd be a total of $25,000. It'll be interesting to see if that changes if further funding is approved, but that is the case right now. And then the next question with regard to the economic injury disaster loan was, if a company received the $10,000 grant, does that mean that they will be granted an economic injury disaster loan? And no, it does not. So the way that the up to $10,000 grant works is when they open up the applications again, and you can check that box that says, I want this up to $10,000 grant, you would fill in your bank information. And the idea is that amount that they've determined for grant purposes would show up in your bank account, whether or not you are later approved for the economic injury disaster loan. You would not have to pay back that $10,000 grant. And yeah, it would just be a $10,000 grant. The one thing to note is, when we discussed the eligibility requirements, you are essentially self-certifying that you are eligible. So you can't know that you're eligible and then still ask for the $10,000 grant. And then the next question I'm seeing, and Michelle and Laura, you might want to jump in on this. This is one that we've actually kind of debated. It's regarding there was a comment that the SBA has updated and corrected the calculation for payroll costs to include the federal payroll taxes in the PPP calculation credit. I believe what you are referring to is an FAQ that was put out by the Treasury Department on April 6th, which that FAQ does state that it can be relied upon, but I would caveat that with that it doesn't have the force of law. I think that in our discussions, we kind of ended with the idea that the employee side of the federal tax withholdings are not excluded from the payroll costs, but that the employer side is. But I'm going to let Michelle and Laura jump in on that.
Wow, this one is really hard because the statute says include state and local employment taxes, do not include federal withholding taxes. And then the regulation says exclude employee and employer FICA and income tax withholding. And then the FAQ is a little bit all over the place. I think this is a prime example of the internal contradictions that I was talking about earlier, and the hope that the SBA will provide further guidance. With respect to what to do about it, I'm not sure. I think that's something to ask the lender about how they intend to treat it. We've seen some variety as to how lenders are treating certain expenses and certain payments. And I think the best thing is to be completely upfront about which expenses and which costs are going into your calculation, so that when you, and when I say you, I mean the borrower, goes to certify that the information they're providing is complete and accurate, it really is complete and accurate and fully disclosed to the lender. And I'm sorry for the answer, non-answer, but we've sort of gotten guidance, non-guidance from the government.
That's a perfect way to put it, Michelle. So thank you. I think there's one other question that we received when it came to the actual registrations, and it was, and I'm just going to kind of read the question. It's specific to this person's business, but I think the answer would be beneficial to all. So the question was, our rent exceeds 25% of our salary being paid now, and our labor is less due to drive-through only. We are not paying people to not work as they make more on unemployment. We plan to keep the remaining money. Must we document the use of the loan portion? So, and Michelle, feel free to jump in. My understanding is that if you're not going to spend at least 75% of that Paycheck Protection Program loan on payroll costs, then that's going to reduce the amount of the loan that is forgivable. However, that just simply means that you now have a loan at 1% that'll need to be paid back within 2 years. It does open you up to be able to pay, like to use the loan proceeds for additional costs that aren't available to be used for forgiveness purposes, but it is still, you are still limited in what you are able to use the loan proceeds for. So that's kind of the caveat. So I would still make sure that you're documenting the use of the loan portion, since you are limited in what you are able to spend the loan proceeds on.
I completely agree. It's a difficult situation to be in, especially if your employees are better off collecting unemployment and you have nothing for them to do anyway. But that is one area that is pretty cut and dry, the 75% rule.
Michelle, can I jump in quick? It's John. If I recall correctly, that the SBA and or the Treasury did issue a statement that beyond the forgivability requirement, you must spend 75% of the loan on payroll, which is not what the statute says. So we had some discussion about that, and our thought was you could conceivably continue spending on payroll after the 8-week period and therefore be in compliance with that that regulation, which again, I don't think is supported by the statute, but you wouldn't be getting forgiveness for that spend after the 8-week period, but it would at least be compliant with the overreaching regulation.
So I believe that is it for the questions, but as Michelle and John have stated, we have spent a lot of hours within the CARES Act, reading different guidance and regulations, and then just even speaking about it amongst ourselves. So we'd be happy to continue that discussion with any of you. And in your packet of information, you should have our contact information should you want to reach out with any questions or just to discuss.
Dan, I believe there was one other question regarding the employer retention tax credits, and I think the question was whether a nonprofit like a 501c6 Chamber of Commerce could qualify for the ERTC, and the answer is yes, as long as they are a tax exempt organization. Then that would satisfy that requirement to be quote unquote carrying on a business in 2020.